Imagine owning a fractional piece of a massive billion-dollar company. It sounds like something reserved for the ultra-wealthy, but it's actually how personal wealth is built every day. It works through a unit called a share. When a company decides to go public, it divides its total ownership into millions of tiny, equal portions. One of those portions is a share. Think of a share as a single brick. Buying that one share means you own one literal brick in a giant corporate structure. When you hear the word stock, think of it as the collection of bricks you hold. You can own stock in one company, or you can build a portfolio by owning bricks across many different businesses. This system of accessible fractional ownership allows anyone to start small and build their own stake in the economy, one brick at a time. To buy these bricks, you need a marketplace. For the United States, the central hub where investors meet to trade these units of ownership is Wall Street. The name comes from a literal history. In 1653, Dutch settlers in New Amsterdam built a dirt wall and a wooden fence across Lower Manhattan to protect their colony. The wall eventually came down, but the location remained a gathering place for local merchants. In 1792, 24 traders met to bring order to their business, signing a pact called the Buttonwood Agreement to set rules for their trades. That agreement created the New York Stock Exchange, turning a local trading spot into a massive institution that helped New York become a global power. By evolving from a defensive dirt barrier into an organized exchange, Wall Street provided the structure needed to fund businesses and grow the national economy. As the country expanded, the marketplace had to connect with people far beyond Manhattan. Investors in other cities needed a way to trade without traveling to the stock exchange in person. The telegraph solved this by allowing markets to send orders and share prices across long distances instantly for the first time. In 1867, the invention of the stock ticker made this even faster. These machines used Morse code symbols to continuously print market prices onto long strips of paper, giving everyone access to the latest data. This high-speed access occasionally led to chaos. When bad news broke, investors could use the technology to sell all at once, creating a selling avalanche like the famous market crashes of 1929. Instant communication changed Wall Street into a market that stays constantly in sync with the rest of the world. We often associate Wall Street with corporate profits, but the money moving through this system directly builds the world we live in. This happens through tools like municipal bonds. A bond is basically a loan where a local government borrows money from everyday investors to pay for big projects. For example, when a town needs to build a new school, they raise the millions of dollars needed by issuing bonds on Wall Street. The same process funds the highways and bridges we use to get to work. Investor capital provides the upfront cash required to complete these massive public works. Wall Street functions as the plumbing that carries private savings to the construction sites and public projects that need it most. Because anyone can buy shares, you can use this engine to fund your own future. When you put your money into a retirement account, you are taking your own cut of the economy's overall growth. To keep learning how to successfully navigate these complex markets and invest your money with confidence, hit the subscribe button. Once you understand how individual bricks stack together, Wall Street becomes a clear, practical tool for your own financial security.